So
Okay.
welcome, James, to the Wealth Wisdom Financial Podcast. So glad to have you here. Um, tell our listeners a little bit about your backstory, a little bit about your career, what brought you to where you are today.
Sure. So, my name is James, and I have a family. I'm married and have 4 children, and the ages currently range from 20, 18, 14, and 13. My 18-year-old is graduating, so that'll be exciting, and going off to college next year. Um, I have been, as far as my backstory with finances, I've always been interested in investing and learning more about money. As with many people, you don't learn about that in school. And my father was always very, very risk adverse. His advice always to me was don't risk any more than you can afford to lose, um, which makes sense to a certain degree. But I've also found over the years that one of the quotes that I really like is from Robert Kennedy, who says, "Those who dare to fail miserably can achieve greatly." And so those kind of two contradict each other, right? So if you're not willing to risk it all, then it's very unlikely that you're gonna exceed expectations to a large degree. And there's many examples of that. Bill Gates quit college, right? He risked a career, and same with a lot of the large companies that were created, the billionaires that are currently there. They didn't put all their money in a 401k and slowly let it average with the S&P over the course of 30 or 40 years. So as I was learning more about investing and learning more about 401ks and IRAs, I started to question kind of that traditional wisdom as to how you grow wealth. And I went down several different paths. My first investing experience happened to be with a gentleman who would buy companies and then sell percentages to individuals, and they could then sit on the board. He went to prison for 17 years for fraud. So that was kind of my first experience into investing, and that's really where my dad was like, "Don't invest more than you can afford to lose." I'm like, well, I kind of went into debt for that one. So, but that's all learning, and so I wouldn't say that I lost on that. I learned a lot on how to really kind of analyze and verify and that kind of thing. So, as with everyone, or most everyone, right? I get my jobs and I just put money into 401ks and IRAs and try and find the right mix of mutual funds to invest in, and hopefully that grows. And after moving a couple of jobs and rolling 401ks and taking a look at the value and the balances, I realized that after 10 or 15 years, the value of the 401ks was basically what I had contributed. There really was no growth over that time frame, and I didn't really put a whole lot of confidence in that. And so I had also dove into Dave Ramsey and cut up the credit card and tried to do that as well. And as many as there are people out there that come on his show and yell that they've got freedom from debt, I realized it wasn't practical to do that and to have enjoyment in life. and my wife is very big on experiences, and it was really hard to be like, okay, we need to eat beans and rice and beans and put all this extra money into a 401k that will grow. At the time he was saying, and I don't know what his lies are now, but at the time he was saying, mutual funds would grow, an aggressive mutual fund would grow 12% year over year. And I knew not to be true, because I was seeing the performance of these mutual funds, and even before the 2008 crash, they weren't performing at 12% year over year. And so
did you do your own math on that, or just aside, how did you calculate and figure out some of that?
Well, I knew that from the performance of my own 401k.
Mm-hmm.
I look at my 401k that had been invested in these aggressive growth mutual funds over the course of my career to that point. And again, they showed that I was only making what, the value of the mutual funds or the 401k was only increasing by the amount that I was contributing. So something had to have happened to to that growth that was happening in that mutual fund. So in 2016, I switched. Well, 2018, I switched jobs, and in that transition process, I realized that I really didn't want to be working a 9 to 5. I wanted to find ways of investing. And I had invested. I called myself an accidental landlord. I would buy homes, and then we would move, but I wouldn't sell them, and we would just rent them. And gave me experience in investing and landlording. And I realized that with the first one, it was in an area that wasn't great. And since I bought it as a residence, not as an investment, I hadn't done all the due diligence. The cost was exceeding the value that I was getting from the rents. So it may look like it cash flowed month to month, but after turning it over and having to pay for repairs and all that kind of stuff, by the time I sold it, I had a paper profit, but all the expenses, and then of course the IRS clawing back the depreciation, really did not come out ahead on that. And that was just that it was a terrible investment, right? I didn't buy it correctly. So I did buy a home in a really wealthy area here. I bought like the smallest home in the whole town, and that I actually purchased well. And it was an area that was going to be developed. And so lived in it for several years, and then rented it, and took about 10 years, 12 years before it was finally sold to a developer. And I was able to make 6 figures on that property. So that worked out really well. But it was at that point, I made the money on that home, and I was transitioning jobs. I needed to find a way to invest. How did I want to invest that money? And as I was looking into various options, I was just seeing that stock market wasn't, long-term stock market wasn't necessarily the way to go. And obviously, I already figured sticking money into an IRA and 401k didn't really seem to meet my needs. So I took that money and actually cashed out my IRAs and invested it into building a memory care residential assisted living home. So I've been in the process of doing that, and that's kind of where the Robert Kennedy quote kind of drove me to do that. It was like, should I cash in my 401ks? Should I do this for this business? And I was like, yeah, that's me daring to fail miserably. So I felt that was a good step to do. And my faith has a huge impact on what I do in my day-to-day decisions and long-term decisions. And there was a time where things were a little rough. And so I just remember sitting in church one day and just being like, God, what do you want me to do? And it's kind of the first time and only time I've ever really felt that I heard an audible voice saying, keep doing what you're doing. Just keep moving forward. And so I've kept pursuing the memory care home. It currently is in the stage of half built. because I got halfway through and got shut down by the neighbor who sued me. And it's gone through Court of Appeals, and now we're asking for a transfer to the Supreme Court to follow up with that process. So again, you hear all of the stories about successful people, and we all think that it's going to be a straight line. And I don't know if you've seen the meme of what I thought success looked like and what it actually looked like, right? Over the hills, into the through the swamps, and passing the alligators. So that's where I'm at and what I'm doing with that. And I don't, in that whole process, I don't know where I came across Bank on Yourself. I know that I've heard in various investing association meetings or conferences that I've been at, I've heard different individuals talk about infinite banking, whole life insurance, dividend paying, with non-direct recognition. And it probably took 4 or 5 times of me coming across it to really start to look into it a little bit further. And I don't know which came first. I don't know if I found the Bank on Yourself book first, or if I found the Not Your Average Financial podcast first. But those two obviously are related. And so I ended up reading the book, listening to a few of the podcasts, and thinking, I think this is probably where I need to go. And I had a lot of that money from the house that I had sold, and thought this would be a great opportunity to kind of get started with that. One of the other techniques that I had used was getting a HELOC as my mortgage. So refinancing the house as a HELOC, and I had that kind of integrated as my checking account. And so anytime I'd get paid, I'd put the money into the HELOC, and then I would use that money. And the reason for that was I always saw that I always had a balance of $5,000 to $10,000 in my checking account, but it just fluctuated. And I was like, what can I do with this money? Sticking in a savings account doesn't seem to be, a great place for it. So I used the HELOC then to try and, offset a lot of the finances there, or the interest charges, ending that because I could get a really good interest rate right before the interest rates went up. And so I refinanced that, but then I also was putting all of my money into this memory care home. And so I didn't really have that fluctuation there. So I just kind of wanted to lock that in, but was looking for other ways to invest the money that I had. And Bank on Yourself showed up, and I like the idea that it's building a foundation. So yeah, it's not returning 12% a year, but it never loses 12% a year or 30% a year, or whatever the stock market happens to do. So there's a lot less fluctuation. It's a guaranteed growth upwards. And then having the non-direct recognition loan was very similar to what I was doing with the home. And that's really how I explain the loans to people, because I'm like, it's like you buy your house and you have equity in your house. You take money out of your house, you're paying the bank the interest, but you're being able to use that money, and the value of your house can continue to grow.
Yep.
The difference is the value of your house can also go down, whereas with the life insurance policies, they don't lose value. So I decided to pursue that, and it's my basis, my foundation. I call it kind of my bucket as well. So I'm trying to create bigger and bigger buckets of money. My process, don't necessarily recommend this for everyone, but because I was trying to create the biggest bucket I could, I would take money, pay the maximum I could, and then immediately borrow that money back out because I needed it. I couldn't just leave it in there. So I was just kind of churning, using the velocity of money, I guess, to build this bucket bigger and bigger.
You do a lot of number crunching yourself, right? When people think that, oh yeah, I'm just going to do this and someone else is going to manage it and it's just going to magically happen. It sounds like from your story that you had some interactions with money and with God to say, what is happening here? And questioning, right? A lot of times we don't question anything. We just say, Dave Ramsey is the gospel or whatever. And you're asking bigger questions, right? And then using it to grow various businesses. Some worked, some didn't.
Right. Yeah, I don't just take answers at face value, especially when it comes to money, because it doesn't add up. You see, again, I go back to, the billionaires that are out there. They didn't get there by doing the things that you're taught to do in school. I also worked for several years at Charles Schwab. So I've been in finance, and I know that financial brokers, stockbrokers, their goal is asset acquisition.
Yep.
That's what they're there for. And so they advertise and recommend what they can to acquire as much as they can and keep as much as they can for as long as they can. And I worked in the reporting department too. And so I know that what they're looking at is total assets under management and what is the spread between what we're paying in interest and what we're receiving in interest and what we're receiving in fees. And if you think about a stockbroker, this changed slightly while I was there because the fees from $15 a trade down to $4.95 and then eventually went to zero. But they were no longer looking at what are we getting from commissions as revenue. They were looking at what are we getting from interest rate spreads.
Yep. And
this was during the first low interest rate environment before they started to raise them in 2019, 2020. And for every point of interest rate that Charles Schwab went up, or that the markets went up, Charles Schwab was going to make half $1 trillion in additional. So they wanted interest rates to go up because they could generate revenue because they have so much money under management, assets under management. So when they tell you, put your money in and stick it in a mutual fund and let it sit there for 20 years, that's because they manage that mutual fund and they have that cash there. The people that they make the least amount of money on are the old people that, and this was the example when I was there, it was the older people that had AT&T stock that pays a dividend that they've held since the 1930s or the 1920s or whenever, that they just inherited it from their father who inherited it from their father. And now they've got, tens of thousands of shares and are making thousands of dollars in dividends every month. And they call in every day asking what the stock price was. So they're costing Schwab money and they're not trading it. They're just getting payouts. And that's a cost. So Schwab would rather they sell that stock and buy their mutual funds. And that's the same with all of the brokers. They're not interested in people trading. They're interested in people sticking their money in a mutual fund and letting it sit there.
Yeah.
So
thanks for sharing that, James, and sharing some of your background there. I was hoping you would get into that. And I guess it's been 5 years now since we started working together and you started implementing Bank on Yourself for you and for your family. What was on your mind when you were like choosing to not just have like one thing, but to get your family involved and to become, the person that helps your sons, for instance, get started, and even at young ages? Like, what drove some of that part of it too?
I wanted to provide the education for my children that I didn't get when I was growing up. So I spent my 20s with my head in the sand, really not knowing a whole lot about finances and just sticking it in the 401ks. And then 30s is when I really started to learn and educate myself, and having to do that outside of any traditional method, right? Listening to podcasts, reading books, going to seminars, and that kind of thing. And I want to pass that and give onto my children and give them a foundation. And I wanted to start them out with a bank on yourself policy, so that when they are old enough to start managing on their own, that's something that's already put in place. They've already moved past the first several year period of trying to get it to grow. So it's really, the big focus was on my oldest son. He got a job, and I started with the idea of using a Roth IRA, because the idea of a Roth IRA is that it's after tax money that you put it in. Then you can invest that money and grow it. And again, with my prowess, I guess, with my education, I didn't just stick that in mutual funds. I would invest that. And because it was after tax contributions, anything that we put in there, he could take out at any time. So I looked at it as like a savings account plus. And we did that for him, and we also did that for my next oldest son. And that was what I thought was a good idea. What I have learned since is, anytime the government sets the rules, it's not in your best interest. I mean, they set the rules for themselves, and that makes it, and then those rules there are to make it as difficult as possible for you. And that's really what happened with these IRAs. After setting up the IRAs, I did learn about the bank on yourself. And for my oldest son, it was like, he graduated from high school and he didn't want to go to college. And I was fine with that. Again, college is another one of those things that maybe started out as good intentions, but has become blown way out of what really it's supposed to be. And so he loved cars. And so I got him a job as a mechanic, and that's what he was working on. And so he never went to college, and we set up a policy for him. He needed to buy a car. We didn't have we had too many drivers, not enough cars. And if he was using one every day, we needed him to have his own. So we set up a policy for him to put that money in there so that he could borrow the policy and buy his own car. And that's what he did. And then the next goal was for him to pay that back and save up for his house, which...
Could I ask you a quick question here?
Yeah, sure.
So I have a client or potential, right, that is going through and 27. And just in your own words, why would a 27-year-old put into a policy, a life insurance policy, versus just a savings account? He's like, why would I do that? I don't even understand. I'm borrowing for my own money. And it just doesn't make sense to me. And if you were talking to that 27-year-old, what would you tell him? Like, what's the logic there?
Yeah, so there's a couple of different things, especially for a 27-year-old. You put money in a savings account, and savings accounts are growing they're better interest rates now. In the past it was ridiculous. There wasn't any interest, but some of the interest has grown. So there seems to be a reasonable amount of interest rate in there. The Fed's going to lower interest rates again, and savings accounts are going to go down faster than the Fed goes down. So again, the bank's not interested in paying you money. They're interested in what they can make off of your money. So if you put the money in a savings account, as soon as you use that money, it's no longer earning anything and it's gone. The bank on yourself policy, I talk about the velocity of money. It's the ability to use the same dollar over and over again. And so if you put that money into a bank on yourself policy, if you need to buy something with it, you do borrow out of that policy, but the money is still growing. The interest is still accruing in that policy because you didn't take the money out. It's still available. And then you pay that policy back as you're earning more money. And the benefit there is there's no requirement to pay that money back. It's up to you. Now, obviously, you want to pay it back as quickly as possible because you want to be able to use that money again for something else. Again, it's using the velocity of the dollar, and the interest and dividends that you earn on the policy only slightly offset the interest that you're paying for borrowing that money. But there's no one's going to come repo your car because you didn't pay the loan payment that month. You're not going to lose your house because you didn't pay the mortgage payment that month. And so you really are in control of that yourself. Again, you want to be in control of your money. And I feel like these bank on yourself policies give you that opportunity. And then the other side too is if something happens, then that loan is taken care of automatically by the policy. And a 27-year-old who's invested in the policy will have significantly more life benefit for the cost. It'll be cheaper for them to get or death benefit to get a larger death benefit than if they put that money into a savings account and then bought a term policy. That's another kind of one of those fallacies that Dave Ramsey's and others have said, right? It's like buy term policy and invest the rest. Well, every 27-year-old I know, unless somehow they are able to do the whole FIRE method and save every single penny and not spend anything, they're not going to be able to do that because things come up, expenses come up. Expenses expand to fill the amount of money that you have available. And so you're not going to continue to invest that money and rely on that term. The other thing is a term policy, if you don't die, you spent a ton of money for nothing. You get no return on that. So my wife has a policy that's ending this year. The 20 years is up this year, and we've spent $10.80 a month for the past 20 years, and we'll have nothing to show for it. In that regard, I'm glad I didn't, would not want to have had to have cashed in that policy. But we also have a bank on yourself policy for my wife that has more death benefit, and we can do more with that policy than we can or could with her term policy. Yeah, it's a little bit more expensive, but if you start when you're younger, then there's a whole lot more that you can do. So going back to the 27-year-old and really talking about my son to bring the story full circle is he passed away December 31st of this year. And the bank on yourself policy paid out. He had almost $400,000 in value, in death benefit. So the $5,000 that he paid for his car, didn't have to worry about that. We just had to provide, death certificate and accident report, and we had the money within 30, 45 days. It took 60 days, almost 90 days to get the money from his Roth 401k or his Roth IRA. I had to jump through a ton of different hoops to get that. And even now, that money is stuck in a inherited Roth IRA that we have to hold we have to hold that for at least 5 years from the time that he opened it to be able to get any of that money out without having to pay any taxes or penalties on it. And we can hold it for 10 years, but there are so many rules and regulations around that. Whereas with the life insurance policy, it's, they sent me a check and I cashed that check.
Mhm.
Obviously, that's not what anyone is considering or wanting to think about when they purchase the policy. But it was such and there's no silver linings, there's no blessings, but it was helpful to not have to worry about any of that.
Yeah. And I remember when you called me, I think I was in the car. I called you right back. We talked for a little bit that day, and I just said, focus on your family. We'll start getting the ball rolling. Um, and I was glad to be there for you and your family in whatever way I could. And we
Right.
made sure, right, we were able to get you that check as quickly as we could in coordination with the life insurance company. But knowing like you had 3 other sons to be thinking about and caring for. Like a lot of people, when they think about insuring their children, they're like, how morbid, they're not going to die for a really long time. Why would I even think about doing that? And your family was able to do something beautiful to celebrate your son's life and to be a family, right? Shared your wife loves experiences.
Mhm.
There's been some really good things that now you're able to do for your family going forward from that. That yeah, I was able to buy the car, get the car, loan, you don't have to worry about it, but also like moving forward, I think looking back, um, you're really glad that you have done these things and you're continue to teach your younger sons the importance, right? Pass on that financial education to them. That's probably even more powerful than the big check that you got. Yeah, and
Yeah.
the day that we're recording this episode, the day before, the New York Times, yes, the New York Times published an article that says, "Was the 401k a mistake?" That's the headline of it's in the New York Times Magazine. And here's one of my favorite quotes from this article. 401ks have arguably become another driver of the inequality that is the defining feature of American life. And that really the only people who have made money from the 401k are wealthy people who could like max it out. They had money they didn't need to touch, all those things, and the investment firms that set them up and get all the fees. Only people that have made money off the 401ks, not the average American, not the ordinary person who they're like, I don't even know if I can contribute because I'm living paycheck to paycheck. That's what that article ended up being all about. There's so much more they could have shared about it, like the volatility of the stock market and all those kind of things
Right.
eating away. But I'm glad mainstream media, they're finally starting to see the
Maybe
wealth wisdom behind, right? Like that the conventional isn't necessarily what it's all cracked up to be.
When I worked at Charles Schwab, we would always get calls from people who they were getting contributions into like a SEP IRA or some other small business IRA. And, it's these 20 somethings calling up and saying, hey, can I have, withdrawal? It's like the day that the money was deposited into the account, they were taking that out because they couldn't afford to leave that money in there, or they didn't think they could afford to leave that money in there. So they're taking the 20% penalty and the tax hit to take that money out because it was that much more that they could use for their living expenses. And, we looked at that as they're not being fiscally responsible. They're being irresponsible with their money. But I know plenty of people that it's not a matter of being fiscally responsible or irresponsible. It's a matter of putting food on the table or being able to afford gas to get to their job. So the same applies to, building a policy. You have to be able to afford to take that money out of your account. But I also know, and this is kind of the idea behind the profit first methodology, that if you can take that money out and take it out of your paycheck early, then you don't have that income to expand your expenses to, and you'll live within that income that you have. And that was the other thing that I was really trying to impress upon my children, my sons, that when they got their first job, they were going from zero to whatever money they were making. And if their paycheck was $100, they were going from 0 to 100. That's an infinitely more than they were making before. So why not just take half of that and put it into a savings account, put it into a policy, and now they go from 0 to 50, which is still infinitely more than they were making before. And then they have that 50 that's being saved on the side for future whatever they can borrow for a car or for a house or for college. And so that's kind of how I want to teach them as they get raises or they get more money. They focus on saving a good portion of it and living within that smaller amount. And I'm never expecting that they're going to be at 50% for the rest of their lives. But now when they have zero living expenses, if they can go with 50%, then they should, because I don't think they have any expenses that exceed what 50% of their income right now should be. And that's just not something that I learned. And so my expenses have always run up to what my income was. And once you've set some expenses, it's really hard to go back from that. And you set a certain expectation with your spouse and your children as to what their lifestyle should be. It makes it a lot harder to pull back from that.
So one of the things I've learned is in doing this is people want the easy button. They want the easy button as quick as possible. Do it, and in our and we also are tithers, and we think about the law of the first fruits and saving versus investing, right? But in our business, and I want to ask you like specifically, we of course specific because you're the one here, but all right, so we do a full financial analysis. We don't just say, okay, here's a $35,000 policy, go ahead, go for it, and now I'll go do this. But we have to ask a lot of questions. You and your wife are probably on the call, I bet you. And it takes a lot of work for you to come in and share and brain dump all of this. But I think for me as a financial professional, it is fiduciary for me to do that. What was it that you said, oh, I'm going to give all of this time and effort to Amanda to do all of this and then trust her that she knows what the heck she's doing in here? And how is that overcoming? Because you have Schwab experience, right? And now Amanda's a female as well, right? So what made you decide, okay, I'm ready to do this? And why is that so important for a financial professional to actually get their stuff together and ask those questions? Why is that so important to do a full financial analysis is what I'm asking.
Well, you said, being a fiduciary is one of the pieces to that. And having been in the financial world, I know what that means. And it means that you're required as a fiduciary to put my best interest above and beyond your interests. So you, as a fiduciary, you cannot recommend something that will make you more money than it will, make me, right? It's got to be a benefit to me. I'm also realistic to know and understand that you've got to be paid for your time. So there's going to be fees associated with it. You've got, again, everyone said, not everyone, but a lot of people are like, don't get the whole life policies because the only person making any money are the agents. And I know that these policies are not built the way that a lot of the other policies are built, but I also know that term policies make more money for insurance agents than well-built whole life policies. So, and I did a lot of research on it. And also, so having a full financial workup is important, because then I know that you're creating a policy that's good for me, not just one that can make you more money, right? If I come in and say, I have $150 a month that I want to put into a policy, you don't know if that's a good use of that $150 or not. Or you may be able to look through that and say, well, you've got $150 that you want to put in, but we can actually create a bigger policy or better policy if we do a little bit of the shuffling over here. And then that's going to create this policy that does X, Y, Z. So it'll be, better than what you had originally thought of or planned. The fact that Amanda is a female really didn't cross my mind at all. I mean, I don't care about that. But one thing that I do know is that women in the stock investing world, an example of that is they are much more likely to be successful than men, because they tend to follow the rules a lot better than men do. They're not as arrogant and bullheaded as men are when it comes to, like, I can do this better myself than following the rules. So there's a little bit of comfort there, knowing that, women tend to build the plans around the rules that, are set in place, and are going to be more likely to do that rather than trying to deviate from the plan to try and make it look bigger or better or be bigger or better or whatever. So sorry, Brandon, I prefer Amanda.
Oh, I would expect. And she is a rule follower. In our marriage, you might be around this, apparently. I'm like, come on. Let's, and I'm more male, I guess. I don't know.
Yeah.
And it's been such a great pleasure to get to know you and your wife. I think that's been a very important part of our relationship, is that it's not just you and me working together, but Tina's been involved. And I know she hasn't always wanted to. She's not as interested in talking about money as maybe you and I are. But to be able to build that relationship's been really important. And I don't know that every financial professional would have taken that active of an approach too.
Yeah. We got married and we decided that she'd do all the grocery shopping and I would do all the finances. And she recognizes that, she needs to learn more about that as much as she doesn't want to. And so she does take a bit of a role in that, and begrudgingly is willing to join me in things. In calls and that kind of stuff, so she has a general understanding of what's going on. But the other thing I know is that if anything ever happened to me, I know that you guys would help her.
Yeah, and hopefully we never have to deal with that, but we would.
Right.
That's part of what we know that we're here to do, just like we did with you, with your son, even more so for her. Right. This has been a great conversation. Thank you so much for sharing your story and being so vulnerable and honest. Really appreciate that. Anything that you wanted to make sure to share that you didn't get a chance to, or anything that you'd want to triple underscore by way of wrap up? What's that nugget of wisdom?
I would say that get started with your kids early. Even if you don't have a business, read Profit First, because it really is applicable to your personal financial life. Because if that money is not a part of your income, then you're not going to spend it, and so you're more likely to be able to save that. And learn about the velocity of money. Don't stick your head in the sand. You need to figure out how to do it, because banks, there's a reason they have the largest buildings in every city. It's not because they're trying to make you the most money that they can. And so, yeah, figure out how to do it for yourself. Work with Amanda and Brandon, because they don't have the biggest building in Cincinnati. So, and yeah, get started early.
Perfect.
The
Thanks so much, James.
Best time to plant a tree is 20 years ago. The second best time is today.
Boom. Mic drop moment. Love it. Thank you so much.
Awesome.
You're welcome. Thank you.
Give